Hello, everybody, and thank you for tuning in for another really informative and educational webinar that we're holding today. Today is a very focused webinar, and hopefully you're going to get a lot out of it. We will have this up on our website, so please, I'm sure if you're here because it really relates to you, you may have some friends or family that may be able to use this, and we'll have this on our website for them to go to. Without any further ado, let's get started. How to maximize your employer stock compensation. That's the presentation. And our presenters today, I have 19 professionals that I'm surrounded by, and both Nicole Goebel and Vincenzo Testa are two of our wealth advisors. They're both CPAs. Nicole is also a certified divorce financial analyst, and Vinny is a CFP, certified financial planner, and they will be doing the presentation. They really put a lot of work into this. I think you're going to find this presentation to be really informative for you. So planning for stock compensation. Today we will discuss optimizing stock awards in relation to market volatility, diversification, and income taxes. And the different type plans that both Nicole and Vinny will be reviewing will be stock options, incentive or non-qualified, restricted stock awards, performance units / awards, and employee stock purchase plans, better known as ESPP. So let's get started. I'm going to hand off the presentation to Nicole. Go ahead, Nicole.
Thanks, Steve. So we're going to start out talking about how market volatility may be affecting your equity awards, and also, the importance of diversification when it comes to employer stock awards. So as Steve mentioned, we're going to be focusing on different types. So whether it's options, restricted stock, employee stock purchase plans, basically all of those are going to give you really exposure to the company that you're working for, right? So not only may you have your salary, your benefits related to that company, but by having those additional awards and part of your portfolio exposed to that company, there is some financial risk. So, that's one thing to think about, is how much of your total wealth and your total income is exposed to really the health and the growth of that one specific company. So that's something important to think about. And again, of course, I would hope that everybody is working for a company they believe in and believe will be profitable and grow long term, but it's just something to think about from a risk perspective. If you work for a private company and you might be issued incentive stock awards or restricted awards that, basically are only related to those internal individuals. Only employees, owners have access to that. Really, it can lack liquidity, right? So that is a big risk, because what happens if you want to leave the company? Will they buy that back from you, or do you lose those options? And again, if you need access to those funds instead of getting a bonus or a salary, that's really tied up in the company and not liquid for you to utilize towards a home purchase or a car purchase or anything else. If it's a public company, there are other liquidity risks, right? So, obviously talking about volatility, we see the stock market goes up and down, and that individual company may go up and down. But there are blackout windows that often apply to executives or people with what's called material non-public information to avoid insider trading. So that can also be a risk. Again, are you allowed to sell your shares at different times throughout the year? So again, if you're looking to purchase a home or, fund education for your child, whatever expense might be coming up, are you going to be able to sell those shares when you need to? So let's talk about one way or one solution that you can really kind of avoid those blackout windows. It's called a 10b5-1 plan. So this illustration is just showing you, under normal circumstances, if an individual might be, again, an executive, have that insider information, they may be very restricted as to the windows that they can either exercise options or sell shares. So you can see here in my chart to the right, it's really showing you that only, where those arrows lay, or where, might be the opportune time between earnings calls, for example, where they're releasing information, that you might have a very narrow window, maybe 30 days that you can sell. So that really, again, provides a liquidity issue there. A 10b5-1 plan, what that allows you to do is create a plan that you're predetermining that you want to regularly exercise options or sell shares, so that, again, you issue this maybe for a year, you register it with the company, and there is a cooling off period, but you're putting in place a plan. Right? And that's the key here. All of our discussions today are around planning. So I've included a couple examples. For example, I'd like to sell 200 shares of my company stock in XYZ as long as the price is $80 or higher at some point every month, right? So now I've really put in place a plan where I am regularly selling shares, but only if the price is above where I would want to be selling. So again, that's protecting me from just having to liquidate at a lower price than I'd like to. Or if I had options, exercising 1,000 of my incentive stock options to, purchase XYZ stock, but only if the market price exceeds my strike price by $25, right? So again, I'm putting some type of protection in place that I'm not executing at a price that I don't want to. These are just two very basic examples, but the idea here is once a plan is put in place, and again, you'd work with a professional advisor to set this up, you would have a cooling off period. That's what my yellow dot here shows, is basically once that cooling off period, then all of these other windows throughout the rest of that year would open up to you. And again, it's not something you set for 5 years or 10 years, but maybe a year at a time, just to make sure that, again, you can regularly diversify out of your awards. And let's talk about single stock risk, right? I have, a large company, of course, everyone in our area certainly knows GE. And, really was that wonderful story of a very well-diversified business, well-run company. And you can see here in the orange just how amazing that individual company did compared to the S&P 500 below it in blue. And this is a chart from 1990 to the year 2000, right? So, many of our clients who own GE said, why would I ever sell? Look how well it's doing compared to everything else. I want to hold on to it. And the issue there again is you don't know what's to come in the future. And it's really important to think about all the risks that come with a single company compared to the overall market. So holding a more diversified portfolio long term makes more sense because yes, it might not outperform all of the time, but it's protecting you on the downside, and that's more important. So again, this story in the 1990s tells, oh my gosh, this company did phenomenally compared to the market. Since then, if we take a look at a chart from 2000 to current day, it's the complete reverse, right? You've now lost over 60% of your value from those highs in your GE stock, whereas up here, you can see that the S&P 500 has continued to grow long term through all of the different events we've had, the financial crisis, COVID, last year's, downturn in the market. Really, the S&P 500 has grown long term. So again, when we think about single stock risks, it's not that, again, you don't believe in your company growth and your company potential, but it's you want to make sure that at least your retirement nest egg and a good amount of your net worth is in something more well diversified long term. Okay. So let's talk about what are the tools that you can use. We talked about the 10b5-1 plan to get over, doing the liquidation when there's blackout windows. But what else can you do? If you have a tremendous amount of stock, right? There are things you can do with an advisor like us, like a covered call strategy, or even kind of exchange funds where you can exchange a very large concentrated position over time. But what can you do as just a layperson? Right out there. Well, my recommendation to clients is always periodically sell your vested shares, right? If you're someone who might receive restricted stock every year, on that anniversary date, look at the shares you hold and say, oh, well, I have these shares. They're either in a long-term capital gain or loss at this point, and start divesting them, right? Start selling them and investing in something else because you're receiving more awards at every vesting date as well. So it's not as if you don't believe in the company and don't continue to have exposure, but it's avoiding that overexposure. Also, when you have non-qualified stock options, and Vinny's going to talk about this on the tax side of things, but you're already being taxed at ordinary income tax rates when you exercise. So instead of coming out of pocket to buy those shares, instead simultaneously sell or do what's called a cashless exercise. And again, Vinny's going to be talking more about that. In other areas of financial life, what can you do? Well, avoid purchasing company stock in your 401k. And some of you may say, hey, that's not even an option, but we see it. So again, many individuals still hold, in some cases, up to 50% of their 401k plan in their employer stock, right? That's unnecessary exposure because it's a tax deferred account and you can buy and sell as often as you'd like. So, something that definitely you should avoid if you're getting that restricted stock or you have options or are participating in that employee stock purchase plan. Also minimize exposure to that specific company or even maybe the industry in the rest of your portfolio, right? Just to not be overexposed in that area. And also when we talk again about having to sell or exercise at inopportune times, build up emergency cash, build up brokerage accounts with more well-diversified investments, because then you have other areas to go to when you have those near-term goals versus having to, again, sell shares when the market may be down or it might not be the best tax environment for you as well. I'm going to pass it off to Vinny now, who's going to talk about vesting and tax planning considerations around these different awards.
Thanks, Nicole. So in this section of the presentation, I'm going to discuss each specific type of equity compensation, from ISOs and non-qualified stock options to RSUs, RSAs, PSUs, and PSAs. And I'm going to talk about when the tax is assessed in each of those types of equity compensation and at what point the tax liability is being generated. And I'm also going to talk about what kind of tax liability is being generated, right? Is it ordinary income? Is it long or short-term capital gain rates? Alternative minimum tax is another outlet that comes into play with ISOs. And then net investment income tax is a surtax that's charged on investment income for individuals with income over a certain threshold. Okay, so first talk about ISOs or incentive stock options. So talk about when the tax liability is generated. So there's no federal tax when you exercise a stock option, but it could be subject to AMT, right? And that's alternative minimum tax. And when at exercise, you could have the spread between the exercise price and the market value added back to your taxable income for AMT purposes if you hold the shares until the year end. So that's something to really pay attention to, and I'll get into in the near future here as I'm speaking. And then, after exercise, you sell your options, right? And that could be taxable as a qualifying disposition or a disqualifying disposition. A qualifying disposition would allow you to take advantage of long-term capital gain rates. And a disqualifying disposition would consider the gain on sale as a short-term capital gain rate, which would pretty much be taxed at your marginal tax rate. So the long-term capital gain rates is really what you want to aim for. And the qualifying disposition, for it to qualify, you have to hold the options 2 years from the grant date and then 1 year after you exercise. So this would not apply in a situation where you're doing a simultaneous exercise and sale. Another tax planning consideration that you could use to your advantage is an 83B election with a qualifying disposition. So like I was saying before, ISOs could be subject to AMT. And the 83B election could help you avoid that, right? So when you file an 83B election, it means that you're filing an election to exercise your options before they vest, right? And when does that come into play, and when is that a great idea? For instance, if you work at a private company that could potentially be going public in the near future, and you expect the stock is going to shoot up. So before the IPO goes off, you could file this election, and your exercise price and your fair market value of the stock before the vesting happens could be pretty much close to equal, right? So in that instance, there'd be a little to no spread add it back for AMT. And I'll go into that a little bit further when I'm talking about this spread and what that means and how your taxes are calculated in that regard. So the 83B election could be really advantageous to exercise your options early. And I'll show you a very powerful example on the next slide, which is actually a real life situation. This is actually a projection I did with a client of mine. And so you can see on the left-hand side, they had ISOs, they were working at a private company. And like I said, the company was planning to go public, and client was expecting that, the market value of the shares would shoot up to 1 million in terms of his options that he owned. So on the left-hand side, you could see that's the tax with the 83B election. So on the bottom right there, the total federal tax in this situation was $85,500 just about. And on the right-hand side, this is when AMT applied, right? This is what would have happened if the client had not filed that 83B election. You could see down there on about the 6th line up from the bottom, alternative minimum tax. And that's really the difference here between the two situations, that the client paid $260,000 in AMT because the projected spread on the exercise price and the fair market value after IPO was 900,000, and that amount had to get added back for AMT purposes or alternative minimum tax purposes, and the client would have had to been taxed on that. But with the 83B election, the AMT did not come into play because the exercise price and fair market value was around the same before vesting. So this is just a detailed calculation of how the AMT is calculated when you don't file the 83B election. So you can see there in the highlighted line that incentivized stock options, when you exercise them, you have to add back the spread, like I said before. And in this instance, the spread was projected to be about $900,000 after the IPO. So you can see that we're starting with AGI at the top and adding back certain deductions like taxes and the spread on ISOs there to get to your alternative minimum taxable income. And that's where the AMT is calculated from. Okay, so next I'll talk about non-qualified stock options. So at exercise, it's a little different. So the difference of the fair market value and the strike price is taxable as ordinary income, and it's subject to payroll tax. So that's showing up on your W-2 and in your pay stub at exercise. And then at sale, the difference between the acquisition price, similar to the ISOs, is considered a capital gain or capital loss. And that's another situation where you could take advantage of long-term capital gain rates there, as they're much lower than marginal tax rates. Early exercise, similar to the 83B elections with the ISOs. At grant, the strike price usually equals the fair market value of the stock. So if you're able to take advantage of that 83B election with the non-qualifieds, it's really a good outlet to do so. But there are some risks with doing so, like leaving your job at a certain point before the vesting schedule hits. And Nicole will get into that later in the presentation. But if you ever want to move forward with this and file an 83B election, it's really important to talk to a professional, because there are a lot of caveats and things to consider for tax purposes and risk purposes. So just something to keep in mind there. Okay, so this is an example of a non-qualified stock option exercise and hold / exercise and sale. So, in this situation, I'm gonna describe what happens in these two situations. So in both situations, the details are the same. So we're exercising 1,000 non-qualified options. The strike price is $10. The current stock price is $25. So on the left-hand side, you can see the exercise and hold scenario. So the strike price is $10 and there's 1,000 shares. So the cash needed to purchase the shares would be $10,000. So something to keep in mind in this situation is you have to come up with the cash to exercise and hold. And in the exercise and hold situation is the only situation out of the two where you could take advantage of those long-term capital gain rates, right? The other scenario is the exercise and simultaneous sale. You can't take advantage of the long-term capital gain rates on the gain above the exercise price, right? So that's why this exercise and hold strategy is great, but you just have to come up with the cash. And in this situation, you have to come up with $10,000. And like I said before, the spread between the strike price and the current stock price is taxed at ordinary income. So so $25,000 market value with the current stock price subtracted by the strike price of $10,000 is going to be $15,000 of ordinary income tax. And we used a combined, we used a 24% federal rate and a 6% state rate as an example. And that tax is going to be estimated at about $4,500. So in this situation, you know, you're coming out of pocket about $14,500 to purchase those shares, but you're holding the shares. You hold them for over, you know, the qualifying disposition and take advantage of those long-term capital gain rates, right? So this is tough, right? You know, more often than not, these numbers are much larger than that. It might be hard to come up with the cash and find opportunities to take advantage of this scenario. So you're holding the shares in this situation. So in the next scenario, the cash needed to purchase the shares are $0, right? That's great. You just, you know, exercise and sale and take your money and run. And the ordinary income is the same, right? It's $15,000, the spread, and the tax is the same, right? But the total net cash received in this situation is $10,500, and you don't own those shares anymore, though, and that's really the caveat. You can't take advantage of those long-term capital gains and any potential growth in the future. So just something to keep in mind there. Okay, next is restricted stock awards and units. So I'll just talk about RSUs to start. So RSUs are restricted stock units, and they're a promise for shares at a later date owned by employee at the grant date. And RSAs are usually issued to early employees before the first round of equity financing, and those are restricted stock awards. So with both, they're similar in a lot of regards. So they're usually on vesting schedules. So you can see on the right there's a vesting schedule. So January 1st, 2020, that's the grant date. And then every year after, the RSUs or RSAs are vesting by 25%. So, you know, for example, you know, you have 100 shares every year, 25 shares are vesting. And at vesting, they're being taxed as ordinary income in your W-2 in your paycheck. And a lot of people that receive RSUs and RSAs maybe don't look at their pay stub too often, but when this is happening, this is just showing up in your paycheck and you might not even notice it. And when the ordinary income is recognized, the shares are being sold behind the scenes. Your RSUs are being sold behind the scenes to cover the taxes within your paycheck, and the shares are withheld within your pay stub. So if you have RSUs, you know, try to pay attention to your pay stub around the time that you expect that your RSUs are vesting. So another tax that comes into play is the capital gains tax. So for the vested shares that you hold after the fact and sell after the fact, capital gains come into play. So opportunity there to take advantage of those long-term capital gains and holding over the threshold period of time. And then 83B elections also apply to RSAs as well as non-qualifieds and ISO. So RSAs and RSUs, really popular form of equity compensation. Okay, performance stock awards and performance stock units. So kind of similar to RSUs and RSAs. So in this regard, they're both the company's giving you stock, right? Versus options where you're getting the option to purchase the stock at a specific price and they're not giving you the cost basis, right? In this situation, they're giving you stock. So PSUs and PSAs, there are a target number of shares or cash equivalent at a future date that could vary based on company performance as they're measured against defined goals. And the way these differ is the vesting schedule is usually over a longer period of time, right? And it has a cliff vesting, right? So it's sort of backlogged in terms of the vesting, and the vesting is sort of pushed towards the end of the vesting schedule. It's a little bit heavier in that regard than the RSUs and the RSAs. And the tax treatment is pretty similar to RSUs and RSAs. Okay, so employee stock purchase plan, last but not least, so and otherwise known as the ESPP. So employees elect to contribute a percentage of their pay towards purchasing employer stock at a discounted price, and that discount is usually about 15%, right? And this is really a great opportunity. If you have opportunity to purchase your company stock at a discount of 15%, I would try and do as much as you possibly could. It's really a great benefit. The ESPP is really a great tool to maximize your retirement benefits while purchasing your company stock at a discount. Shares are taxed when they're sold. So when they're sold, The discount that you received is taxed as ordinary income, and that's in your W-2 and in your pay stub. And then you could also, exercise that qualifying disposition. That phrase keeps coming up. So if you sell the employee stock from the purchase plan 2 years after you were offered it, and 1 year after you exercised it, the remainder could be taxed as a long-term capital gain, and that's really a great benefit. Again, really pushing that envelope there. That the long-term capital gain rates are significantly lower than short-term and marginal tax rates. So, that's a great benefit there. And then again, the disqualifying disposition, the discount would still be taxed as the same as ordinary income, but the remainder would be taxed as short-term capital gains. Again, taxed at the same rate as your ordinary income. So last, we'll talk about tax pitfalls and solutions. So taxes withheld upon vesting and exercise are often not adequate and can lead to interest and penalties. So that's what this is really important and what we're trying to push here. A lot of employees that receive stock compensation or equity compensation, they don't have much guidance in this regard, and sometimes they may at filing, after they exercise some equity comp or sold some RSUs, might have huge tax liabilities at the end of the year that can come up and surprise them at filing time. So it's really important to work with a professional, a tax professional, financial professional, to help them lead the way on this subject for you. So in terms of your vesting, work with your CPA to determine if any additional tax should be withheld on your wages, or if you can make estimated payments to make sure that you're paid in to avoid interest and penalties at filing time. Really important. A lot of what Nicole and I do for clients here at the firm, and it's really helpful and saves clients a lot of money. Exercise, ask your custodian if you can customize your withholding rates before you exercise. Some custodians will allow you to do some won't, but if they do, it's really a great benefit. Just look into that if the situation applies to you. And then proactive tax planning. Again, I showed you an example earlier about how the 83B election really helped one of our clients here at the firm. Have your CPA prepare projections before any exercise, vesting, or sale of ESPPP, because there's a lot of moving parts. As you can see, we just reviewed them all. Each different type of equity compensation has its own set of rules, and it's really important to get in front of it, because it could minimize your tax liability, and it can reduce penalties and interest at filing if you're planning around it correctly and you're doing all the right things and doing your due diligence. And I'll pass it off to Nicole to talk about risks of transitioning after receiving equity comp.
Thanks, Vinny. Thanks so much for talking about all the tax considerations. And as Vinny mentioned, some of this gets really complicated. So it's really important to understand your specific awards, right? Every grant document is a legal document. Some allow 83B elections, some do not. And we're going to talk more about the specifics related to your awards and making sure, again, you have a good understanding of different risks associated and different opportunities, again, for tax planning. So I'm going to talk about one more kind of type of benefit that many executives we work with take advantage of or ask us about: deferred compensation plans. So what is it? So I know around here, certain people have, New York State deferred compensation plans, but this is different. This is a non-qualified plan. So it would be with an employer who is not, a government entity. So what are the advantages and what are the disadvantages? So this allows someone to put more pre-tax money into a retirement account and grow tax deferred above and beyond the normal 401k limits. Right? You're able to not only defer, but in some cases, your employer may also be putting in some type of additional match. But again, it's a non-qualified plan. It is not protected under ERISA law the same way your 401k plan would be. What's the advantage to doing this? Well, if you're a highly compensated individual, when you distribute this later on after leaving the company, you may end up paying lower tax than had you taken that income in the current year. What are the disadvantages? Well, this type of plan is not eligible for a rollover to an IRA. So upon leaving the company, you will begin to receive distributions. Now, this is really key. Distribution elections are typically made when you choose to defer. This is often more than a year before you're going to receive that salary or bonus that you're choosing to defer a piece of it. Now, a lot of times those are not revocable, but sometimes the company, if you've made a mistake or you've just not elected anything and it's gone to maybe the default of a lump sum payment when you leave or 5 annual payments when you separate from the company, there may be a one-time option to adjust. And oftentimes it just requires that you're kind of pushing that out another 5 years, which might not be a bad thing, again, if you're leaving the company but continuing to work and not retire. Another risk, and going back to talking about the financial risks, again, involved with, having too much associated to one specific company. Technically, again, these balances are not yours. They're not guaranteed. They're considered assets of the employer. So again, if concern around the health of that company, these are assets that could be at risk if something happens to that employer in the future. But again, tax planning around this, the distribution side of things is really important to do. So what would happen to your awards if your company was involved in a liquidity event? So whether it was acquired, whether it merged with another company, this is really important. Again, specific to your grant. So you want to read the details. Would you have the same vesting schedule? Do your awards immediately vest? I've often seen that where upon a liquidity event, your unvested awards would immediately vest to protect you. Do you lose any unvested awards? Right? Will you be replaced with equity compensation from the new firm, or will you be paid out a cash equivalent? So again, important to understand the risks associated to that type of event and also tax plan around them. Again, if you're going to receive a big cash payout for awards that you expected to receive over the next 4 years, make sure you're talking to a tax professional to plan for that appropriately. What if you leave your job? So as Vinny mentioned before, again, this is something that comes up as well around the 83B election and a risk you could be taking potentially by exercising early, but then never actually exercising those options. We've often seen that individuals will lose all unvested awards and have only 90 days to exercise any vested options really upon leaving that company. So that's important to understand, right? In some cases, you will be able to keep those options for the full length of time, but it's really important to understand that before you give notice. So to make sure you're not leaving anything near term on the table, right? Maybe stay after that next vesting date to receive those awards. However, many grants or employers will have specific language as to what's considered retiring from the company versus just being terminated or separating from service. There may be a specific number of years of service with that company or a specific age where you're considered to be retired. And we have seen where individuals then are allowed to keep those options for the entire schedule and even may receive part of their unvested options as well. So just really important to understand when you're making those decisions. So in summary, we leave you with, stock compensation is a wonderful benefit, but make sure you're understanding the financial risk, make sure you're understanding the tax implications, and make sure you're receiving the guidance you need around these areas. It's something that we do often with our clients. Again, it's unique to every situation. So please let us know if there's anything we can help you with. Thank you so much.